Thanks for tuning into the All Funds Network podcast. My name is Mike Schroeder. Today we're here with my co-host Skyler Steinke, and we're also here with Vincent Randazzo. Vincent is a chartered market technician. He's also founder of ViewRight Advisors and creator of the Defender program, a systematic risk management overlay for equity portfolios. We're going to get into the details with that here in a minute, but he brings over 2 decades of experience, previously serving as Chief Market Strategist at Lowry Research, the oldest technical analysis firm in the country. It's great to have you, man. Thanks for joining us.
Yeah. Thanks, Mike. Thanks, Skyler. I appreciate being here. It's a good time.
Yeah, great to have you on the show. Absolutely.
Yeah.
Absolutely. Let's start a little bit with your background, and we'll get to where we're at today and with your product. But let's start with the kind of brief background, and I also want to get into the CMT stuff a little bit.
Yeah, for sure. Okay, good. So I graduated from college with an economics degree in 2002. Awesome time to do that. Obviously, with the market kind of melting down for the prior 2 years. So yeah, I always joke like I wish I had just been born like 6 years earlier, and then I would have had a totally different outcome. But that's the way it was. So the roundup of that was that it really sort of framed my idea of what risk is all about. Like just the idea that you sort of do have to manage this thing called risk, even though you're young and stupid. You still have to manage that. And I was lucky enough to work on a desk at Morgan Stanley when I started with in the equity research sales group with some really open-minded people that were really keen on just integrating all sorts of different type of analysis, including technicals. And because I had always just been taught, technicals are just kind of a little bit out there. They don't really do much. People just use them and they don't really know why. And I said, there's got to be something to that, And I think our group was sort of influenced by the technician who was the technician for Morgan Stanley at the time, Rick Bensinger. He took the place of Phil Roth, who of course is very famous in his own right. And Rick was just awesome and really just kind of shared his time with our group a little bit, and we kind of got influenced through by him. So that's how it sort of started out. And I realized that there is something to technical analysis. It does add value. And our whole job there was to sort of amalgamate the message of research and, get that out to the clients, right? So just being really concise and be able to add value about all the different stock ideas we were talking about at the time. And what I found was that you talk a little bit about technicals as a way to help with the timing and conviction of whatever you're hearing from the fundamental side. That just gave you a huge edge. So fast forward a few years, I continued down the same path. I went to to UBS in a similar role, and I was like, well, I might as well formalize this sort of differentiating factor, which I think there is in technical analysis, by getting certification, on being a technical analyst. Like, why not just do that, right? Put a little validity to it. And so I studied for the CMT. I got that and kind of moved on from there. And again, it was just a way for me to not be as commoditized in a really competitive market. So I was in New York, and everyone is super smart, everyone's super aggressive, and they have plenty to add. But if you're able to differentiate yourself in any kind of way, it's an advantage, right? So that's kind of the beginning of my career, and then obviously just kind of been around since then, and subsequently moved down to Florida to work at Lowry Research. It was just, for me, a great honor to work with Paul Desmond. He was somebody really well known in the technical community for many, many years. He had owned Lowry Research for I think 50 years and run things there. And he sort of took me under his wing and mentored me, and he was just gracious like that with his time. And I just learned a ton about everything I didn't know. I was very focused. Prior to that, I was more focused on the price side of the equation and not so much the internals, not so much the momentum, not so much the breadth. And although I had studied it in the past, especially when I was at UBS, I didn't really sort of solidify that as a factor in what I did until that point. And that's sort of what the basis of what I built came from, is really that idea of breadth and taking all those principles I learned from, start of my career, risk management, and then, momentum analysis, price analysis, and then putting that, breadth piece on top of it really just putting it all together and making a system out of it.
Yeah. Okay. So, take us where you're at today, and then I'm gonna take us back again.
Okay. Yeah. So as of January, I started ViewRight Advisors, and what we've done is just created an easy way for people to, whether it's institutions or or financial advisors, to get the market call right, in a systematic way. So we use market breadth and 100 years of market breadth analysis, and of course 25 years in my career doing analysis on major market tops and major market bottoms, and figuring out, okay, what are some of the common traits that we find among tops and bottoms, and how do we, I guess, optimally position for those different risk reward environments, right?
Hmm.
So it's really distinctly different from regular research, which is sort of like, it can be a little squishy at times. I think we've all, heard technical analysis from different people. It's sort of like, well, it could be this, it could be that, it could be this, it could be that kind of thing. And that can be frustrating for people, especially in moments of stress. You kind of want to know, hey, what's the deal? Like, where can I feel confident? Where can I feel comfortable? Where should I be, looking for my edge? So basically, we have four choices in every single uh, report we write. It's just, you're either 100% invested, 66%, 33%, 0%. And those are just defined by our parameters around breadth, and what is breadth telling us about the liquidity situation in the market, and the volatility in the market, or
Yeah.
expected volatility, I guess I should say.
Yeah.
Right. And then
Okay.
just positioning according to that.
Got it. So there's a lot to unpack. So you're looking at things like breadth, potentials for highs, lows, maybe risk reward, and expected volatility. Those are kind of some of the key parameters, if you will.
Yep. Yeah, exactly.
Now with let's go back to the CMT. So CMT, chartered market technician, right? Uh, tell us a little bit about it. It's something I don't see a ton of people have it here. I went for my CFA. If I knew CFT was a thing at the time, I might have taken that route. But just kind of give us like the high level. Like, what is it?
Yeah. So chartered market technician. So basically, what it is like the CFA, in the sense that it's a way to certify yourself as someone who is a trusted practitioner of technical analysis, and that includes the ethics side of the equation too. So again, I think there are a lot of similarities between CFA, CMT at least. One is just for technical, and the other is for fundamental. And it's a great community of people. I mean, everyone's really looking to help, and it is a smaller community compared to the CFA or the fundamental community. So I found that because it is a little bit smaller, you actually do get to know people, and there's a lot more camaraderie when it comes to that. So to me, it's a great organization, and they've done some amazing work in terms of solidifying, I guess, the level of respect that technical analysis deserves in a process,
Mhm.
and that there's a place for it, right? And that there's a place for it, there's a time for it, and these people who earn the designation are the people who sort of can speak for the discipline in a way,
Yeah.
right?
Why do you think so many people think that technical analysis is kind of voodoo?
It's a good question, man. I think it lends itself to that, because we have to think that there's something more complicated going on as humans, right? Where I think, um, to me at least, the technical side of the equation, it actually gives so much credit to the market. It gives so much more credit to the market. It basically says, hey, market, you are computing a billion computations a moment. I'm a single human. I don't know better than you. So what I'm going to do is I'm going to take my cues from what you, Mr. Market, are telling me. And that's what, my process does. That's what most technical analysis does, is it basically just says, hey, I'm deferring to Mr. Market. Whatever Mr. Market says, that's what I'm going to believe. Whereas I think that, and I'm not trying to disparage, fundamental analysis, but I think fundamental analysis is sort of trying to make that edge in a way, and saying there's something wrong with the way the market is valuing this particular situation or company, or these things. And as a result of that, we found this advantage, right? So that's what I think is sort of the difference. Yeah.
Yeah,
Yeah.
I agree. I think I like I said, never like studied it professionally, but I've dove pretty deep into technical analysis, and that's really all I look at when I trade the charts. And it's kind of funny too. I feel like a lot of like the fundamentals kind of follow some of the technicals, where it's almost like a lot of the news is like timed for kind of like equilibrium breaks to some degree from what I've seen.
Yeah. Yeah. And it's so funny, like in certain markets where there aren't that many fundamentals,
Mhm.
Technicals work. It's the only thing. Like crypto is a great example, right? Like
Yeah.
digital assets is just such a great example of technicals and how they really do work, because you literally have no other factors that you can call as being a fundamental factor. When you talk about a lot of these cryptos, I'm not talking about all of them because
For
I can't
sure,
speak to that
especially
point.
a lot of the earlier ones, meme coins.
Right. Yeah, exactly. So it's interesting. To me, it's just fascinating. And, one of my earliest memories and technical analysis in the business was with Rick Bensinger. And he, again, I think this was October of 2002. So just at the market bottom, I guess CNBC said, "Hey, you're doing a hit right now." He didn't have a jacket, right? So he went to our group and he said, "Hey, you guys got a jacket? I'm going on CNBC right now." Like, all right, cool. So somebody lent him a jacket. He went on, and it was the day of the bottom. And he said, "We're getting exhaustion signals in our key indicators that tell us that this could be the bottom." That was the bottom. And I was like, after that, I was like, wow, like I'm kind of hooked here. Like I got to at least investigate this and see for myself, what this is all about.
That's really cool. How has your opinion changed over time, or based on the knowledge you've gleaned over from when you started your career doing this to where you're at today with this new program that you've kind of developed over time there?
Yeah. Oh, great question. And I think the biggest thing for me is that I'm just so much more open minded when it comes to different types of analysis. But I'm very, I guess, intolerant of like opinion.
Yeah.
Like anything that could be seen as opinion or conjecture or anything like that, any shade of subjectivity, I just don't want it. I don't want any part of it. I don't care how smart you are. I don't care how many billions of dollars you manage.
Yeah.
I really don't want it to be in my process. Some people, they can work with that. I personally can't. So my job is to keep it as objective as I can. And what that does for me is it keeps the emotions out of it, and it just makes it systematized. And when you systematize something, you can repeat it over and over and over again. And if you're able to do that, that's how the best in the business make their money, right? Is they
Yeah.
find a system that works, it's repeatable, and they just keep repeating it over and over and over again. And core to all their processes is protecting the downside. Like that's anybody's process, like that's always the key. These like super successful hedge fund managers, the guys that we all know around the world, that's so key to what they do is always protecting the downside. So that's why I built my system the way I did. It's called the Defender. The Defender.
Mhm.
We're designed to do that.
Yeah. I like what you said about just kind of keeping your thought process, staying the course. You don't care what other people are doing or saying. With that though, I mean, have you had bouts of emotional kind of when things are happening? I'm sure trying to keep that in check, as we all do.
For sure. Yeah, exactly. And that's what makes us human.
Yeah.
Um, and I think for me, is after building a process, it's basically about saying you trust the process even if you think it's wrong,
Yeah.
right? Because as soon as you abandon it, then you have nothing.
Right.
Then you have part of a process which isn't anything. So that's something that I've just learned over the course of the last 5-10 years, which is just stick with the process. At least you have something to go back to and say, okay, this is what happened, this is why it happened, I know why it happened,
Mhm.
and maybe I need to change something in my process. That's fine. But still stick to it, right?
Yeah, and that goes to, I guess, where I was going with that question. From what we see in the marketplace with many advisors out there, they use risk overlays. They either lag or trigger too frequently. What's the biggest mistake maybe that you see in the industry? How the current regime tries to manage risk? Obviously, what you're doing is a bit that different. But what do you see, currently in the current state of affairs as you're talking to clients?
Yeah. Yeah. No, I mean, as far as the mistakes that I see consistently are just this idea that we can just ride it out, ride out any volatility and it's going to be okay. And I think for the most part,
It works till it doesn't.
yeah, until it doesn't, right? I mean, I think for the most part, in the last 16 years at least, it's been that way.
Yeah.
They're right. But there are secular bull markets and secular bear markets, where you have many years stretched together that the market tendency is just to go higher. And that's what we've been doing since 2009.
Yeah.
So I think there's a whole generation basically that just thinks that there's always going to be a Fed put, there's always going to be a Trump put, there's always going to be some backstop that's going to save you no matter what. And which means you just should buy every single pullback, every single dip. And I just think, that's not going to last forever. So we just need to look at history as an informative guide and say that, hey, look, risk is always going to be there in some way, shape, or form. We just always have to remember that, the market is not going to change its stripes because it has to do with, human psychology. That's not going to change. There's always going to be fear. There's always going to be greed. So at some point, those are going to be factors that are probably going to, try to mess with your process. If you don't have one, then, you're going to have to find one. Right.
And I guess to build on Skyler's question with when it comes to like the process, like what are RIAs doing today? Like, are they just saying just keep buying, like, hold forever, or do they have other, kind of risk management systems implemented?
Yeah, I think that for the most part, I think the RIAs that I speak to tend to be more open-minded, tend to be more flexible in their approaches. I still think that there's a lot of work that needs to be done in terms of really having a framework for managing risk. I think that there's a bigger problem on like the financial advisory side, like the bigger sort of brokerages,
Yeah.
where they literally just they don't do. I mean, there really isn't a plan when it comes to risk management.
Mm-hmm.
The best answer you're going to get is asset allocation, and I just think that that's not a great answer for them because that's what everybody says.
Right.
Yeah.
Yeah.
So what is your edge? You know what I mean? Like, tell me why am I paying you 100 basis points personally? I could pay the other guy 100 basis points. He's doing the same thing you are. Why you? So I just think for their own good, they should really figure this out as far as, what's a process for managing risk. I mean, I think it's important. I don't know. For me, like, again, I told you early in my career that I didn't want to be commoditized, right? There's all these smart, capable people out there who work really hard. How do I set myself apart? Well, I would think about it the same way. If I were a financial advisor or an RIA, what sets me apart? What's my edge? And if it benefits my clients and it benefits me in terms of higher AUM over the long term and better compounding results at the same time, then it's a win-win-win all the way around.
Yeah.
Mm-hmm.
Yeah, for sure. And then to your point earlier, and then advisors, they often say their clients want risk managed portfolios, but they hate seeing cash on the sidelines, right? How does the Defender program help advisors manage both the math and the messaging relative to what you're doing there?
Yeah. So that's a touchy subject when it comes to a lot of people. Like raising cash, it's very touchy. So I think at least for us and the clients, we have and I've spoken to about us, it's tax advantage accounts,
Mm-hmm.
right? And then those people who are nearing or in retirement, because now you've got this sequence of return risk that you've got to deal with where, okay, well, if I'm going to retire soon, I can't take a 30% or 40% drawdown because I just don't have time to recover from it. So, those are the situations where I think that you can really, really help folks out. But I think you can get really creative. I mean, if you don't want to raise cash, then fine, don't raise cash, but put some hedges on, right? And at least you know when to put your hedges on. So for our institutional accounts that we speak to, that's a big thing for them, because if you think about hedging a portfolio, what does that cost per year? In a calm year, that's like a 1 to 3% drag if you're doing traditional hedging strategies with options, because you're always hedging. So it's always costing you something. Now, if you could just narrow your focus as far as, okay, instead of hedging this whole time, I'm only going to hedge for this particular spot of time where I've got elevated risk according to, our metrics, then you're going to save a lot of money because you're not hedging all the time. And you're going to benefit on your hedges too, because they're actually going to pay you, right?
Yeah. So let's unpack it. So you kind of gave us the high level on the Defender. Let's break it down a little bit. So tell us, kind of how is this? You guys just went live in January, so kind of walk us up until now. I'm sure you got a lot of like historical data, things like that. Like how'd you go about building this?
Yeah. So what I wanted to do is build something that is robust, that doesn't give me a lot of signals, that is just based on history and based on something that is pretty immutable. And I kind of centered around breadth, and then, momentum around breadth. So what I mean by breadth is basically the advanced decline line. So New York Stock Exchange advanced decline line, how many stocks are going up over how many stocks are going down. It's an addition subtraction problem that just goes back all the way to the 1930s, right? Or 1920s. So
now what does this tell you?
So to me, it just says, so when it's rising with the major indices, it's telling me all systems are go, things are healthy. The small stocks are marching in the same direction that the large stocks are marching in. And the reason why there's a discrepancy there, or a point of contention, is that if you think about if you think about any of the big indices, the well-known ones, they're basically market cap weighted, or in the case of the Dow, they're mega cap skewed, because, so at the end of a cycle, what happens is that it's sort of like think of it like a game of musical chairs, right? Where the music is going and the music stops and you've got to find a new chair. Well, at a certain point, there's only a few chairs left, but because, we're people and we're greedy, we want to keep sitting in those chairs, and we want to keep buying those stocks and get the last bit of juice out of the bull market. So we end up crowding into the biggest and the strongest names. That's just the natural thing to do, because they're the last ones historically that fall. So what ends up happening at the end of almost every cycle, 90% of cycles, what'll happen, and this is what I based it, because it has a 90% predictive rate, is that you'll get a negative divergence between the advanced decline line and the major indices. And what I mean by that is that the advanced decline line will actually be in a downtrend, and the indices will still be going up. So you'll be saying, so if anybody looks at the indices, they're going to say, wow, everything's awesome. Everything looks great. But if you look under the surface, what you'll see at those tops is that you've got a history of a divergence. And if you look at somebody's like a random person's portfolio, that portfolio is not going to look anything like that index, right? Because they don't just have those big names; they have everything else in it. And especially in a market like this, where you have so much concentration at the top, there's no way you hold that percentage, that exact percentage of those big names to make it impact your portfolio the way that the index does, right? So, there's this big disconnect that you've got to work around. But it's tell, so if you could figure out, and then I put transformations on it as far as like, rate of change and momentum. So we look at other indicators to tell us that, and to tell us when is liquidity really pulling in? Because that's what I look at it as. I always equate it to liquidity for fundamental people, because if you think about what it is, you're talking about how much money is going to how many different stocks. Mm-hmm. So if you have money, a certain amount of money, a smaller amount of money going into fewer stocks, that's a less liquid condition than if you have a lot of money going into a lot of different stocks, right?
Got it. So you use this breadth in terms of liquidity as well.
Exactly. That's exactly what it's telling me. It's how confident. It's also telling. It's a measure of confidence, right? How confident is a participant to deploy capital? Are they willing to deploy it across the spectrum, to the very smallest stocks to the very biggest stocks? Or are they really they're not very comfortable. So they're only deploying it to the AAA balance sheets, right?
Mm-hmm.
There's a big difference, right? But if you look at the major indices, you wouldn't be able to see that. You need to look below the surface, right? And that's where you see, and that's where breadth comes in, and that's why, I built around that. So it ends up being, when you get these periods of, like I say, I call it withdrawing liquidity. Well, what does that open you up for? It opens up for volatility. When liquidity is being withdrawn, you have a fragile situation. So it doesn't take much to get a reversal of fortunes. And, usually it's a series of news events or something going on with rates or Fed policy or whatever. But the bottom line is that whatever's driving it doesn't really matter because the market's pricing it in for me. I don't need to think about all those things. I just need to watch what I need to watch, and it's going to tell me the answer if I know where to look. And that's a reliable tell, and it's not something that's going to change on a dime. You think about what breadth really represents. It's almost like you can make the case that it's sort of like a freight train, where strong breadth is like a freight train with 1,000 cars. Weak breadth is a train car with 40 cars, and the difference is the stopping time and the reversal time. Right now, if that train car only has 40 cars on it, that could be stopped and reversed a lot quicker than something that's got 1,000 cars.
Yeah.
Right. And that's just like, again, it's just sort of market physics is the way I think about it. It's just like, it's a natural law that the market is part of nature because it's a human, it's an extension of human, emotion.
Yeah. And then the other aspect you're talking about is it's kind of gives you, I guess, 4 options: 0%, 33%, 66%, 100%. So you're kind of breaking into thirds. I mean, I like the simplicity of it. So kind of tell us about how you think about that aspect.
Yeah. So the way I look at it is that because you're considering the market as an entity and it's made up a group of stocks, and that group of stocks doesn't top at the same time. They all top at different times. Mm-hmm. So it wouldn't make sense to have like a binary on-off switch, because that, even if you had it that way, there would still be stocks that are continuing to go up, right? That you wouldn't be able to benefit from that. So it sort of acknowledges that fact that, especially at tops, the market tops at you could have tops 2 years apart, between some of these micro cap or small cap stocks and the biggest cap stock and the healthiest stock. So it sort of acknowledges that fact, and it says, okay, well, then we're going to scale out in 1/3 increments based on these factors. And if they continue to worsen, then we're going to scale out another third. And if it really looks like this is a dangerous topping pattern, like one that we don't see but once every decade or so, then we're going to go all the way to full cash. And that's the way, that's the way it works. But on the way in, it's just, we recognize a total asymmetry of reward and risk. So it's all back in at once. Mm-hmm. Because we know that the market is 75% of the time it goes up. So the bias is always to be long, and the model, in fact, has a bias to be long. It doesn't want to be out of the market, but it has a sort of diametrically opposed criteria, which is be maximally invested as long as we can be invested, because we know historically that's what you should be. But we also want to avoid high probability drawdowns, serious drawdowns. I'm not talking about like 10% drawdowns. I'm talking about like, what we consider like a bear market, what people would consider bear markets. Mm-hmm. So if you put those two things together, you basically have a smart buy and hold, which is what I wanted to create, because that's kind of how I invest. It's just, I don't want to make a lot of decisions, but when I make the decisions, I want them to be backed by a lot of data, so I could be really confident that I'm not going to reverse course in 10 minutes, right? And I think that's how a lot of people like to invest.
Yeah. Yeah. What are maybe some, like, 1 or 2 things as you're talking to prospective clients or advisors? What are maybe 1 or 2 things that they misunderstand about your program? And how do you, a lot of this is education, right? How do you reframe that from them, that, to understand kind of where you're coming from, your point of view?
Yeah. I think a lot of I think a lot of people think tactical, and they just think that, they're binary and they're very slow or they're overly sensitive. And, what we've designed is something to sort of address all of those issues when it comes to being tactical. So it's flexible, it's based on the market and probability-based triggers. So it's all just about, what are the probabilities and being on the right side of those probabilities. And the only way to do that is just through history, looking at, how do we do that, right? And for me, it's this program. For somebody else, it's something else. But to me, this is highly reliable, and it's allowed us to be on the right side of things. So in February 21st, we had our first sell signal in the program in 3 years, right? Like, it's not something that happens often. It's pretty infrequent. So we kind of,
Yeah.
it's not, I didn't want, again,
We'll
this
definitely
kinda goes
dive
back-
into today. Yeah.
Yeah. Like, this is like not something that I want as a person who's running this program, because I saw the market hitting new highs. I'm like, man, this is hard to do this. But even when you think the model is, going to be off or whatever, you follow it because it's smarter than me. And the market's smarter than me. So that's what I'm going to go with. Right. Just as an example. But, you'd be surprised what you hear talking to people. Some people say like, oh, I go with my gut. And I'm just like, how do you test that? Can you show me the back test? I mean, like, I don't know how to evaluate that. I certainly wouldn't hire you. I mean, I don't,
Yeah.
Right. When I think about an RIA too, just kind of building this question again, my thought would be they don't get scolded necessarily when the market drops, but they do get scolded for sure if they miss a rally. Do you kind of agree with that?
I think that's true. I think that's true. But if you think about, I guess, the logical side of the equation, which is, I think that, well, first of all, I think that there's just this acceptance that you can't get out of the way of a bear market. You just can't. It can't be done. It can never be done. So they basically just write that off, and you say, okay, we'll excuse you for that because we know it's impossible. First of all, it's not impossible. Yeah. But think about how much better it is to not have to go through all those sleepless nights where, like, I mean, we've all been through this, right? Like, we've been through bear markets before. Like, how that feels. You're losing a Honda Accord every single day in your portfolio. Like, that doesn't feel good,
More hair,
and more hair, more sleep. So if we could just get on the right side of that equation and avoid that whole part of it, not only are we making more money as advisors along the way because we're not taking a 30% haircut to our own personal income, but our clients are happier and they're not calling us all the time. We don't have to hold their hand constantly as they're ready to pull a plug on their portfolio at the worst possible moment, right? We don't have to go through that. We don't have to have those conversations. So to me, I think if you had to make a choice, it's probably the more logical choice to avoid the drawdown to begin with. Even if you're a little late on the other side, it really doesn't matter as much because you've avoided the painful part, right? Yeah. I think the reason why that is the case is because of what I said first, which is they just haven't figured out a way to avoid bear markets. So they just say, oh, it's impossible. So at least you get this other part right. We know you're going to get that part wrong because nobody can get that right. It's impossible. At least get the other part right.
For sure. And there's really two key things that I want to get into before we wrap up is the trust side of things. And then the kind of more fun part we'll talk about now, like talk about the market today. So you mentioned you got your first sell trigger in February. What happened? Why did the system trigger?
Yeah. So let me catch you up. So we had a multi-month divergence between the advanced decline line and the major indices. So you had new highs, new all-time highs. February 19th, you had new all-time highs in the Russell 1000, Russell 3000, the S&P 500, S&P 1500, right? All these major indices making new all-time highs, but under the surface, you had multiple months where stocks were actually going down on balance. You think about what a divergence means. mathematically, it means that for whatever period of time that is, you had more stocks going down, more than 50% were going down than were going up persistently, right? For that equation to be affected. So that's a lot of degradation to the point where, if you look at other data, for example, percent of stocks above their 200-day moving average, about half of stocks at the time of the high, right? At the time of that all-time high, only about half of stocks in the Russell 3000 were above their 200-day moving average. Like, that's not a high hurdle in a bull market. Like, that's not a big number. People think of peaks in bull markets as being like these manias. They're not. They're not. They're the opposite. They look like manias on the surface because you've got these mega huge companies that look just invincible, right? But under the surface, if you look at the numbers, almost every single top looks this way. I mean, this was not anything unusual. And that's why we just kind of go back to common traits. Okay, these are the common traits. These are the common factors that are shared. So then fast forward. So that was the first sell signal on the 21st of February, sell the third. Then March 14th, we had signs of more weakness, more, I guess we would call like persistence of the weakness, and the momentum had rolled over to the point where you basically don't come back from this without having a pretty steep drawdown, or at least a lengthy drawdown first. And then so we got our next sell signal was to sell another third. So you basically avoided a lot of the pain. I think the max drawdown for the program was 8.5% from that February 19th peak to the April 8th low, and S&P was 19% drawdown, right? Yeah. So it's just kind of an example, a real-time example of how the program worked. And if you think about risk-adjusted returns, and like I said, avoiding those nasty conversations, those nasty feelings on days like we had, that has a price. I think that has a lot of value.
Yeah. And then we're recording this June 5th, so it'll take a week or two to get out. But tell us about what it said since then.
Yeah. So since then, what was interesting is that you think about, again, this idea of tops and bottoms and what are the common traits. So one of the common traits, it turns out, of bottoms is that you've got a period of price discovery, and it usually lasts a certain period of time, at a minimum, a certain period of time. And what happened was that we didn't have that this time. I mean, the market bottomed in a moment because there was a tweet. A tweet was released, and it was instantaneous. So to me, like, historically, when you have instantaneous lows, they tend not to be enduring, because there was really no time for like true price discovery and understanding, and an agreement between buyers and sellers of this is the level, right? This is where demand will gradually come in. This is the demand where institutions start accumulating. There was none of that. So to us, and we didn't see the signals. So we did not have a buy signal. So to me, that suggests one of two things. It's one of two things, right? So it's either that the program needs to be adjusted to account for some type of instantaneous low situation, which to me would sort of question the integrity of the program itself, at least in real time, to do it that way. Or B, that there's another low out there. There's a lower low out there, or another low that's out there, or a test at least. So I don't know the answer, but even as of today, our model is up about 2% on the year, and S&P is trailing behind. But our Sharpe ratio is 1.1, and Sharpe for the S&P was like 0.65. Right. Yeah. And of course you had to take that 20% drawdown. We didn't take that. You know what I mean? So it feels really uncomfortable for me right now. But that's why I have a system. I've got a system. I've got to trust it. Got to believe in history, that history is a guide. It's not gospel, but it's certainly a guide. So we just go with the probabilities. If I've never seen something before in history and it happens, well, it could happen. I mean, it could happen that way. That's how the stock market is. It's just not likely. It's not a likely outcome. So I wouldn't want to bet on an unlikely outcome, one that I don't even have data for, to tell me that what's the probability of this event happening. I have no idea. It's never happened, right?
Yeah. I'd love to get your perspective as well, Vincent, from a technical perspective, but it's like we hit our all-time high, February 19th. We never broke that. So I mean, I would think kind of the most likely scenario. I mean, I'm kind of in line with your signal here. So where it's, kind of, this is a weekly chart right now. The most likely scenario would be, maybe we get a fake out, but I mean, I think we're in for some weekly consolidation.
Yeah, exactly. And I think that something that is just not observed in nature is straight lines. Just think about that. Like, are there straight lines on mountains? Are there straight lines on, even cliffs, waterfalls? Like, there are not really any rivers, right? Like, there are not really any straight, like perfectly straight lines in nature. So anything that's straight in the market, whether it's straight down or straight up, it's hard, you can't really trust it too much, and there's usually some kind of lead up to it, and that's the other part that was, again, incongruent with the way that if that was the bottom, that's just not what we've seen before, because what we typically would see is that there's a relationship between the length of that divergence that you see before the actual drawdown and the time it takes to recover, right? So, for example, ahead of the COVID crash, very short divergence, only 3 weeks. Straight down, straight up. That kind of made sense. That made sense because you had a very short divergence. But even then, you had more of like under the surface, there was more of like a U-shaped bottom. On the surface, it looked like a V shape, but under the surface, it's more like U-shaped. If you looked at the indicators that I watch. So yeah, I agree with you. And again, I don't have any emotional or opinion about this. So I try to keep it just based on the facts and just say, hey, listen, here are what the facts support. Again, there's always new things that can happen. That's what markets are all about. But for right now, it's sort of to be determined. Yeah.
Yeah. History will be written. We'll see. Vincent, one last thing for you. So kind of just tell people like, RIA comes to you, they go, why should I trust this signal? Kind of what's your pitch, elevator pitch?
Yeah. So basically is that, listen, we're looking to the market to tell us what to do. The goal is to get the market view right. So if we're not looking at the market, then where can we look for the answers? This is something that we just look toward history and say, listen, this is what history has guided us to. These are the outcomes it's produced. Here's the probability adjusted, returns that it's produced. And here's what you can expect. It's not, nothing's 100%, certainly. But again, it's a process and it has worked historically really, really well. And it's, for that reason, you've got to at least consider that there's a better way to doing things than, not having a system.
Yeah. Status quo.
Yeah.
Awesome. Well, Vincent, this has been a lot of fun. Definitely love to have you on a couple months, see, kind of how the market progresses from here.
Give us
I'm curious. I'm curious too. I want to know how it ends too.
Awesome. Well, where can people go to connect with you and learn more about your company?
Yeah. So it's ViewRight.ai is the website. My email is Vincent@ViewRightAdvisors.com. And, glad to talk to anybody anytime. But thanks again, Mike and Skyler, for having me. It's been fun. And yeah, I do want to do this again when we figure everything out.
Yeah, we look forward to it. And thanks again for your time as well. And we'll make sure to include all your info in the show notes too.